Hello everyone, this is Terry with Futures.io, and as always I would like to thank you for joining us today. Now, it's my pleasure to welcome back Kevin Davey for today's webinar, 3 Excellent Entries and How to Automate Them. Throughout the webinar, if you have a question, please feel free to type them into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Kevin, and you'll get the pop-up to share your screen. All right, looking good. She's all yours.
All right. Well, thanks, Terry. Hey, and welcome, everyone. And thanks for joining me this afternoon or evening or morning, depending where you are in the world. I'm Kevin and KJ Trading Systems, and today we're going to talk about entries and how to automate them and a bunch of other stuff. But first, I'd like to thank Big Mike, Terry, and all of Futures.io for sponsoring today's event. A lot of you are elite members there, and that's certainly a good thing. I'm an elite member, so it's a good way to get a lot of trading knowledge for a pretty inexpensive price. Okay. So today, for those of you who don't know me and might not have heard of me, I'll briefly go over who I am, and then we'll jump into it. We'll start talking about some great entries and how to build strategies with them, and then how to automate them, and then how to turn them into a business, possibly of a trading business. And as Terry mentioned, questions and answers we'll save for the very end. But I'll stick around as long as I need to try to answer most of them or all of them. So with that, I'll put up this disclaimer. This is a U.S. government required disclaimer. You know, trading's risky. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Hypothetical results always are just that, hypothetical. So everything I'm showing you today, just say, hey, you know, these are hypothetical results. Okay, so just who am I? Well, first, I'm a full-time futures trader, and then I do a lot of other things part-time. There's a picture of me. I was in Australia last December and spoke at a trading conference, which was pretty fun. So I do some of that. I do writing, consulting, mentoring, a whole bunch of other stuff that's, you know, most of it's all trading related though. And I have a couple trading books that are available at Amazon. The one on the right, Intro to Algo Trading, came out in May of last year. It's more of a beginner's level book. And the book on the left came out about 4 years ago, and it's called Building Winning Algorithmic Trading Systems. And it's won a couple awards, and both of them have been in the bestseller list at Amazon now and then. I also have a book that I just put out. It's a little ebook. Well, it's a 40-some page ebook that kind of expands on what we're talking about today. It's all different entries and different exits than what I'm going to talk about today. But if you want it, just visit my website, go to the little thing up at the top that says free. You just have to give me your email and you'll get it, and you get Tradestation Workspaces and all kinds of cool stuff with that. So, but speaking of my first book, the Building Winning Algorithmic Trading Systems, if you stick around at the very end today, what I'm going to do is we'll have a couple of questions, and if you're the right number answer, you'll get an autographed copy, and I'll do that and send it off no matter where you are in the world. But that's kind of my way of saying thanks for sticking around. So 2 people will be getting that. Okay, so that's you know, I talked about books and stuff. I just started writing a column for technical analysis of stocks and commodities. It's called Algo Q&A. So if you subscribe to that magazine, you can see my column in there every month. And if you don't subscribe, it's a good idea too, because it's a really good magazine. You get a lot of good ideas from it. And when you subscribe, you get all the archives, which is pretty cool. But if you have questions, that might be appropriate for that column, I'm always looking for new questions to answer. So, feel free to send them to me. Okay, so that's everything but trading. Here's some of my trading performance. I was able to finish first or second in a worldwide trading contest 3 years in a row. So, I practice what I preach, and I'm able to have had success with it. And the cool thing is I've been able to teach this to other people too. And in 2017 and 2018, the people who won the same trading contest were actually people that I had taught, and you can see their names and pictures there. So that's kind of cool. So what I do is actually repeatable, and I think that's important. It's not something where what I do, I don't think anyone else can do it. I think anyone can do it if they just follow the process. So I think that's important as you look for any kind of educators or any kind of people helping you out. I know a lot of you see people who just are in trading rooms and they trade so fast you don't know what they're doing and you can't replicate them. The stuff I do isn't like that. So just keep that in mind. You want to be able to learn from somebody who can actually teach you and other people can learn it. So I'm outside of Cleveland, Ohio. That was a view out today. You can see there's some ice on Lake Erie and some water. It was a little warm. It was like 40 degrees Fahrenheit today, but yesterday it was all frozen. So it kind of changes one day to the next. But I think the lake temperature is like at 33 degrees, and it just gets a little colder. It freezes, so it's kind of cool. My neighbor saw a fox running on the lake the other day, which is kind of wild. Anyhow, enough about me, enough about lake, enough about all that stuff. Let's kind of jump into what we're talking about. Going to give you some entry signals, and then we're going to talk about building trading strategies and automating them and putting it all together. So we'll finish up with Q&A, but at the same time, if I don't answer them or it gets lost or whatever, or you think about it afterwards, just send me an email. I'm more than happy to answer people's email. There's quite a few people I talk to who just email me questions every once in a while. So, feel free to do that. Okay, so let's just talk about trading for a minute. Trading's getting tougher. And here's just a graph that just kind of shows these are systematic trading funds. So these are, some of the bigger players, but they're generally commodity trading advisors. Some of them are real big, some are small, but on average, that's what their performance has been for the past 5 years. And you can see hasn't been that great, especially this past year, 2018, the average fund lost money. And, there's a lot of reasons for that, but one of them is things are just getting tougher. And there's a lot of new traders coming on board. A lot more people are back testing. For example, I saw something, this one group, I think it's Quantopian, they run a website and they allow you to back test, and they have a couple 100,000 users, and they said they've done over 9 million back tests. That's a lot. And so a lot of people are out there searching for little edges in the market. And so you got to keep on top of things with trading, because there's more and more sophisticated traders every day, and the tools keep getting better. So no matter what you're trading, if it's working today, it doesn't mean it's going to work 6 months from now or a year from now. It might, but you should always be looking at some new things. And they don't necessarily have to be revolutionary ideas. They can be older ideas, and you just kind of redo them and play around with them. So that's kind of where I'm coming from today with some of the entries I'm going to give you. It's maybe some things that you haven't really thought of in your own trading. Maybe it's a little bit different, and maybe you can kind of take these and kind of put them together. But at the same time, you got to realize the entries are only part of the puzzle, right? You know, as much as people love entries, and I know because I do too, everybody likes to know when they're getting in the market. It's kind of cool. That's the only thing you can really control is when you get into the market. There's also a lot of other stuff. You know, there's position sizing, money management, exits, diversification, you know, different strategies you're trading, psychology, all those kind of things add together. You know, it's a puzzle, right? And they all add together to give you a complete picture. So we're only looking at a little piece of that puzzle today. We're only looking at entries, but it's a good starting point. You know, if you don't have good entries, a lot of this other stuff probably doesn't matter, but it's not the only thing. So you know, don't think that. There's a lot to it. Okay, so talking about entries, you know, just so everyone's aware, I'm going to show some entries. These aren't things I created, so I'm not the original creator. It's kind of funny. Well, not really, but I had an idea that I might have actually created, and I was giving it away for a while a few years ago, and then I saw some other trading quote-unquote guru did a video where he said he created it, and he basically took my exact code. He didn't even modify the code I had and claimed it was his. I'm like, oh boy. Well, if he wants to do that, but of course he looks better by saying he created it. But I'm telling you up front, I didn't create any of these things. I'll tell you where the sources are that I got them for. And this is usually how I work with building trading systems. I don't come up with some grand theory of the market. I find what's out there, look at it, think about it, maybe add to it, subtract to it, modify it. You know, I just build off of what other people have done. And it's a great way to kind of jumpstart what you're doing where you don't have to think of things from scratch. I get a lot of people who say, oh man, I just can't come up with any trading ideas. Well, you don't really have to come up with trading ideas. You can just research what's out there and then make some modifications or test them as is. And you never have to really be totally original. Now, obviously, once you get going, you're going to put your own twist on things, so you will have some originality into it, but it's important to realize that you don't need to start from scratch. I certainly don't. Okay. All right. Before I get into it, I've put together, for all three of these, I'm talking about the code in Tradestation format, the code in plain English format, and Workspaces for Tradestation. I've put them all in a package. You can go and download it at that link. I'm sure Terry will be sharing it with you at some point. It's bit.ly/KJ Trading. I think you have to have the capitalization right, though, but if you want to get the whole package, then you can go and play around with that. It's a great way to start. So I put that together for you guys. All right, so let's just talk about entry number one. That's going to be this guy on the left. And it is what I would call a big trading fund entry. If you've ever read the book, Following the Trend, it's a great book. It's really interesting, but he's got a core strategy in there that he says is basically what a lot of the big funds use. It's a trend following approach. And he actually shows in his book how it can be adjusted, you know, with some of the risk parameters, and how it can match performance. So for example, he's got the dark line is some fund. It looks like Abraham Trading Fund. And what he did was just adjusted the risk of this model, this entry I'm going to show you, and he was able to get the performance in the dashed line. So a pretty good match. And then he was able to do it with another strategy or another fund. And there's all kinds of examples where he's able to replicate their performance with this simple strategy. So that's pretty neat. You know, it's a neat place to start. If nothing else, it's a good benchmark to use. So you could say, okay, well, I'm going to use this entry as my benchmark, and I'm going to try to do better than that, but at least I know, you know, I can use that and get similar to what some of the big boys have, and there's a lot of power in that. So here's what it is. This is in Tradestation format, so I'll kind of read it through to you, but basically you have kind of a flag that's going to say it's either true or false, okay? And then we're calling that condition 1. So if the average of the last 50 bars is greater than the average of the last 100 bars, then it's true, and vice versa. If it's not, if the 50 bar average is below the 100 average, then the condition is false. And I'll show you a sample trade in a second so you'll get an idea on that. So once that's established, if it's true, then you can go long once you close at the highest high of the last 50 bars, and vice versa for the shorts, okay? So pretty straightforward. You know, there's not a lot to that. It's basically you're looking for the moving averages to be aligned a certain way, and then you're trading the highest high of the last 50 bars, okay? And then to exit, you're just looking at a trailing ATR, 3 times your average true range as a trailing from the high point to exit. Pretty simple. Yet that can be used to replicate what a lot of big funds do. So that's kind of interesting. I mean, you think about these funds have a lot of very sophisticated people, and I'm sure they add a lot of value, but at the same time, a lot of their performance can just be duplicated with this. That's kind of neat. So here's an example. This is with 60-minute soybeans. I just took this. And you can see your light blue line is your 50 bar moving average. Your dark blue line is your 100. So your 50 is above your 100, so that means what? That means you can go long, okay? And then I don't have the 50 bar high close listed here, but you can see where it says buy, that the bar before was the 50 bar high. And if you took a straight line across, you could see it's above, it is the highest close of the last 50 bars. So that's when you buy, and then your stop kicks in. That's the red line. And then you can see at some point you close below the stop point, and then that's when you exit. So this particular trade was a loser. It happens. It's always good to show losers instead of winners. You know, some people always like to show the winners, so I like to show both. But that's it. And once you're stopped out, you might get back in. Now, obviously, there's a lot of different things you could do with this, but this is the base performance. And I just took a 2-year period. Why 2 years? Usually when I'm evaluating a system, I first start with the 2-year because I don't want to use all my data up. But for a 2-year period, it did pretty well. You know, it bounces around, but you know, it's generally making new highs. And again, I didn't do any optimization or anything. I just took exactly what was in that book and I just applied it to a 60-minute chart. Will it work with every chart? No, I'm sure not. Will it work with every market? Probably not. But again, it's a starting point, right? Now, obviously, if you were going to build a strategy with this, you'd want to test it for more than 2 years and do different markets, different bar sizes. But really, you don't want to over-optimize. You might not want to optimize at all. But just remember, you can't say, well, I'm going to try it on gold, soybeans, crude oil, 20 markets, I'm going to pick the top 10, because that's just optimizing, right? It's a different sort of optimizing. You know, usually people think of optimizing like moving average of 4, a 5, a 6, which one's best. But you can optimize with a basket of futures and say, well, I'm only going to cherry pick the best ones. So be careful about that. You know, people will think, well, that's not really optimization, but it is. But you can certainly play around with this. You can add filters to it. You know, maybe you like the ADX as a trend indicator. Maybe you like some kind of price pattern. You could put all sorts of extra stuff on it to try to improve it. You just got to be careful, because what most people do is they will try to do back testing and try to get a great back test, right? And that's what's dangerous. You don't want to make the back test the goal, right? The goal is not to make a great back test. It's to have a good back test. But sometimes the better the back test is and the more you work at it, the worse your real-time performance is. And that's a hard concept to understand. You know, you want to think that you will build a better back test and it will actually work in real time, and that's not always the case, so be careful. So, you know, part of testing correctly is having a proper process to test, which I'll kind of touch on later. But you don't want to just go in and start optimizing everything and try all these different markets, and whatever comes out best, you start trading. Because, you know, remember I mentioned all these people out there who are testing. Some of them are probably doing that, and they're going to end up losing. So you don't want to do what they're doing. You want to kind of have a better process than what the average person has that's testing. Okay, so that's entry number 1. Entry number 2 is what I would call a pro trader entry. The thing about professional traders, usually ones, you know, working for funds or banks or whatever, is they usually like to be long and short. They like to try to be as market neutral as possible, right? They don't want to be all long and the market crashes, or all short. So here's an example with Coke and Pepsi. It probably doesn't even work anymore because so many people have seen it, but you can see the price of Coke and Pepsi where I show the red arrows. They've kind of separated from each other. And if you kind of just think, well, hey, Coke and Pepsi should kind of be tied together because they're both making similar drinks, they should eventually kind of get close. You know, if Coke is overpriced or Pepsi's overpriced relative to the other one, you would think eventually it would kind of come back. So the whole idea here is when there is this divergence between the two, you eventually hope for it to come back, and that's how you trade. You trade long one, short the other. So you can see in this little chart that I show here over on the left, you can see the price of these two were about the same, and then they kind of went apart from each other, and they stayed apart for, I don't know if this is a daily chart or what, but they stayed apart for quite a while before they eventually kind of came back to each other. So this isn't necessarily a really easy strategy to trade because sometimes this divergence lasts for a while. But usually market forces push them back in. Now this is Coke and Pepsi, but it might be this way with gold and silver. It might be this way with wheat and soybeans. you know, there's a lot of different pairs you could look at that you could make an argument, well, they should kind of be tied together. So for example, like with energies, maybe you say heating oil and natural gas are kind of hooked together, because if the price of heating oil skyrockets and stays super high, what are people going to do? There's going to be a certain amount of people who probably switch to natural gas. Now, obviously, there's costs involved, but it still might be worthwhile. And then the price of heating oil might fall relative to that, and the price of natural gas might rise. You'd have to obviously look at it to see if it's a good theory, but that's the kind of thing I'm talking about. And depending how you set it up, it can actually be sort of a neutral strategy. The problem is, with most retail platforms, it's kind of hard to do this. It's kind of hard to model this, because you gotta be short and long. And I'll show you how I did it in Tradestation, but it's a little bit trickier to test. You can't have standard stop losses, because if you do, they're usually based on a particular market. So let's just say you were long crude oil and short heating oil, just for an example. Your crude oil, you don't want it to have its own stop based on its performance, and heating oil to have its own, because then there'll be times where one stop's hit and the other one's not hit, and then all of a sudden you're not long and short, you're only got one side going. So you got to watch out for that. It's pretty tricky. And when you're doing this, if you do a pairs kind of trading, now you're trading two instruments instead of one. So your costs are going to be doubled, right? So that kind of factors into it. And the markets can stay diverged for a long time. There's no rule or that says, hey, these things have to eventually come back together just because they were at one time. Something could happen and they could be completely separate and never come back. So you got to watch out for that. Okay, so here's just a simple example. And what I do is I take the close. I have two data streams, two different markets. I'm going to use gold and silver. So I take the close of gold basically minus the close of silver, and I adjust it for contract sizes and stuff. This is just what I'm doing is I'm taking the notional value of the contract in this example. So I take the difference. That's called my spread. And then I'm going to put a Keltner channel on it. But you could do a whole bunch of different things. You could do Bollinger Bands. You could do anything you want, really. So if the spread is greater than the Keltner channel, like 2 ATRs above the recent Keltner channel, you're going to sell short. And vice versa, you're going to buy. Now that's for one instrument. Now your other instrument is going to have a different strategy. It's just going to be the exact opposite, right? It's going to, instead of when that value, the spread value is above the Keltner channel, instead of selling short, you're going to buy that second instrument. So there's no stops or anything. You're always in, but the way this strategy, the simple strategy is set up, but you're going to be long one, short another. Here's an example. I have gold on top, I have silver on the bottom. The red line down at the bottom of the chart is that spread value. And the charts don't perfectly line up, and I apologize for that, but you can see, look at like early April, you go short and then you go long around the 7th or 8th of April, and then you hold on to that in gold. Well, in silver, you do the opposite. You buy the beginning of April, and around that same date, you sell short, and then you hold it. So you're long one, short the other, and it could flip back and forth. Now this, obviously, this is just a real simple example. There's all sorts of stuff you could do to it. You don't necessarily have to always be in the market. You could have some kind of criteria that says, hey, I'm not going to enter, or maybe if it gets to an extreme, that spread price. A lot of different ways to do it. But what you then would do is you'd evaluate the equity curve for the gold and equity curve for the silver, and you'd combine them. And here I do that here. And you can kind of see I have the gold as the yellow or gold color. And you can kind of see during this 2-year period, it didn't really do a whole lot. It kind of ended around break even. The silver, which is the gray silver color, did a lot better than the gold did. And then you can see the combined one is that heavy blue line. Now you might look at that and you might say, well, wait, the combined curve doesn't look much better than silver alone. Why don't I just trade silver? Why do I want to be trading gold when gold didn't really add anything to me here, right? It was kind of break even this whole period. Okay, well, that's fair enough. But there's some good reasons why this combined strategy is still a good one. So if you take a look at the drawdown, silver by itself in this 2-year period was per contract $19,000. Gold was $24,000. But when you traded them together as a pair, your drawdown was only $14,000. And that happens a lot with this kind of approach, where your overall drawdown goes down because you're trading one long and one short. The margin's a lot less. So silver by itself is $3,700 right now. Gold is $3,900. But when you have a long gold, short silver, or vice versa, your combined margin is only $2,300 right now. It's called span margin. It's a risk-adjusted margin. It's usually not on your standard margin tables. There are online tools to get it. For example, if you're a customer of Matt over at Optimus, I believe he has this tool online through at least one of his brokers where you can just enter in whatever you're doing and it'll tell you what the margins are. Your broker would probably be able to tell you that too. But in general, the point is when you're long one instrument and you're short a related instrument, your span margin is going to be less, because your risk is less. This won't work being long gold and short cotton, right? You're not going to get any benefit from margin with those two because they're not related. But if you think about it, anything that's related that should sort of move together, that's kind of where they're giving you the benefit of saying, well, hey, you're sort of flat, you're long gold and short silver, so you don't have as much risk, and it gives you some benefit. And so when you put that together, lower drawdown, less margin, and you make some assumptions about what account size you need, which I did here, you go from 31% with silver to like a 49% annual return over that sample period of the combined system. So less drawdown, higher return, and it's not shown here, but a smaller account size. Pretty cool. So it's a neat way to do it. And it's also something I mentioned pro traders use, but not a lot of retail traders do this. So, it's not as crowded of a trade. If you want to think of, moving average crossovers, pretty much a lot of people do those, okay? And they probably don't have much success with it because a lot of people do those. So this is kind of a little bit different. The other cool thing is if the market moves a whole lot, things usually aren't as bad for you. If gold skyrockets, silver's probably going to go up. So yeah, you'll make money if you're long gold. You'll lose money on the short silver, but it kind of tempers any kind of extreme market moves. So kind of neat. Okay, so obviously if you're going to take this entry number 2 and build a strategy with it, again, you're going to want to test for more than 2 years. And like I said, you're going to want to try some pairs that make sense. You know, copper and wheat probably does not make sense. Now, it might actually show up as working, but I always like to have something that I understand. You know, copper and wheat, I don't understand why they would work like that. Maybe somebody has a good reason. If you do, type it in the chat, and Terry will, at the end, he'll read it to me. And the other cool thing, you know, you can be market neutral. You just have to be super careful when developing these. So, for example, if the time sessions are different for some of your different markets, you might find yourself exiting a market and you can't exit the other leg, and so then you're going to have some risk you didn't think you had. So you got to be really careful with doing this. And like I said, most retail platforms aren't really set up to back test these. A lot of them, you can trade them fairly easily, but the back testing might be a little squirrely. So you got to be watch out for that. Okay. All right. So let's move on. So that's entry number 2. Entry number 3, another really cool entry and technique, and this one I've used a lot, and I actually used to teach a strategy with it in my workshop. It's from a book called Beating the Financial Futures Market, written by Art Collins. He's a commodity trading advisor. He's written a bunch of trading books. He's out of Chicago, and what he's done is he took a concept of little biases, adding up little biases to get a signal. And what do I mean by that? Well, here's some code. Excuse me for 1 second here. I thought I was going to sneeze. I didn't want to sneeze in the microphone. What he does is he has an input value. It's I'm going to call it threshold, because you're going to want to exceed the threshold. So he said, I just took some example ones. If the close is greater than the 5-bar average, then your bias is long. So you add 1 to the bias variable. If it's less than the 5-bar moving average, then the bias is short. So you subtract 1. Then I'm looking at the highest close. I'm looking at RSI. If the close is greater than open, that's a decent long bias. And there's a whole bunch of different things. I'm not going to go through them all, but the point is you put in little tests that, hey, if it's one way, that's a long bias. If it's the other way, it's a short bias. Then you add them all up, which is what this does. And then at the bottom it says, well, if that variable bias is greater than that threshold amount, well, then it's saying most of your little tests say buy, then you're going to buy. And vice versa. You know, it might say sell short. Now, if you start, you've probably already, I know a lot of you are already thinking, well, wait, I don't want to use those. I want to use some of my own. That's the whole point of this. This is more a framework for you to do all your own little biases. So maybe you have some little indicator that you have found to be of value. You know, Joe's magic indicator. And when it says it's bullish, well, maybe put that as a test, and that gets added in with all these other ones. And you can use a whole bunch. You know, you could use 3 or 4, you could use 10, you could put different weights to them. You could say Joe's magic indicator is twice as important as everything else. Yeah, you could spend probably the rest of your trading career just coming up with little biases and trying them out. But it's pretty neat. It's a neat idea because it's, you know, I think it's easier to come up with little biases that you think have some merit rather than try to come up with everything all at once. Here's an example. the first couple trades are losers, but then here's a bunch of winners. There's some losers snuck in there, but it's just to show you that you can add up these little biases and get some successful trades. And here's the 2-year performance, and I just took 2 years at random. And again, I do this just to kind of test things out without using all my data, because once you use all the data and you start doing things over and over again, you're going to run into issues. So did pretty good, you know. Maybe it was the market, maybe it was the bar size, who knows? But the point is, it might be a good way to kind of come up with some systems here. And again, you know, like I said, you probably want to test with some different bars, different markets. But the big thing is that third point, you probably want to try your own biases, whatever you like. I have some specific ones that I like to use, like momentum-based ones. And at the same time, this kind of keeps it simple. Each individual bias isn't necessarily very complicated, but adding them up can kind of give you something that goes beyond what most people are doing. And again, that's part of the point here, is you want to do some things that may be out of the ordinary a little bit. Okay, so those are the 3 entries. You know, we have our big fun entry, which is a simple trend follower. We have our pro trader entry, which uses long one instrument, short another instrument. And then we have our little biases that we can put in whatever we want to kind of add up and give us long signals or short signals if they're above a certain threshold. Again, you could go to that link I gave earlier to get the code in Workspace. You can also email me. I'll just send you the link. And it's a good way to get started, right? At least with the entry part. But of course, there's a lot more to do. Because if you look at the entry process, okay, you get your entries. Okay, well, I just gave you some. Then you create the strategies. Then you have to test and evaluate the strategies. You have to automate the strategies, and then you go on and you get enough strategies, you create a trading business. But if you look at it, the entries are pretty easy. You know, coming up with the entries are relatively easy because the ideas are all out there, or you can come up with your own. That's not too hard. Creating the strategies, that's hard at first if you don't know, especially if you don't know how to program. Right, but you have to program it. So I would consider that, you know, it's not simple. It's relatively difficult. I think once you get to the point of programming and know how to program, then it's pretty easy. But at first, it's going to be kind of hard. But the toughest part is going to be testing and evaluate. You know, how do you test without over-optimizing? How do you test without curve fitting? How do you know how much data to use? How many variables should you play around with? How many changes should you make to your code? There's so many pitfalls to this, and this is where most people screw up. It's where I've historically always screwed up until I figured out a way to do things a good way. I spent a lot of time over optimizing systems and dreaming about how great backtests look, and then I realized that wasn't the case or even the goal. So that's really hard. But once you do it and you come up with a process, then to automate them is pretty easy. I'll give you an example of Tradestation a little later. It's really easy to automate it once you have the strategy. And then to put it together in a business, that's another hard part, because then you're talking about position sizing and overall risk, and there's a lot of stuff, especially if you're automating multiple strategies, that you got to account for. So it's hard too. But, you know, hopefully that doesn't scare you, but at the same time, you know, I'm not going to tell you it's easy. I mean, if it was easy, everybody would be doing it, and there'd be no money to be made, right? because we'd all be just giving each other money back and forth. So it's really hard to, one, evaluate strategies, and two, to then put it together into some kind of trading business. So as far as like the evaluation and testing, I use a trademarked process that I created. It's called a strategy factory, where I go from goals to real money operation, and there's a bunch of tests you run in between. That's kind of what I teach, and I've been able to teach others, and they've been able to do pretty well with it. And I use it in my own trading. So that's my process. And of course, once you create that strategy, you want to go automated. And that's not that, excuse me, that's not that tough. It's just flipping some switches, which I'll show you in a second. But you know, you can automate it fully, or you can do some partial automation where maybe you enter on a discretionary basis and let the exits be automated. You know, both can work and both can fail. It's kind of what works for you. But there's definite advantages to automating. You know, you can reduce some of your emotion. You don't eliminate it, and it certainly becomes different, but you can reduce your emotions because a lot of the decisions are already made for you. You just have to not screw it up. But anytime you're dealing with money, you're going to have emotion. I mean, that's really what it comes down to. Emotion is there because of the money involved. Another advantage, you know, you have rules, you can back test them, you can know if you have an edge. That gives you a lot of confidence, and it also helps make your trading consistent because you're always using the same rules. So that's a big advantage. And then you don't have to necessarily sit at the screen all day. I know people who are chart readers who from 9 o'clock in the morning till 2 or 3 in the afternoon, they don't get up for any kind of breaks or anything, which I think is crazy. When you run in automated systems, you can still do other tasks. So, you know, if the markets were open right now, they're not, I'd have strategies running, and if something really disastrous happened and things got out of sync, I'd be able to make an adjustment, but I'm doing other things at the same time I'm running trades. So that's kind of cool. You just got to remember, automated isn't unattended. They're two different things. You know, the big thing with automation as far as a disadvantage, and there's a lot more than just this. I'm just going to tell you one. The computer only does what you tell it to do, and that could be good or it could be bad. You know, if you have a poor strategy, it doesn't matter if you automate it, you're going to lose. And if your infrastructure, your setup is poor, where you're always getting internet disconnects, you're probably going to lose money. And if you don't watch what you're doing, if you don't stay on top of it, you're going to lose money. You know, don't expect to check automated strategies once a month. You know, they used to talk about this with Forex, with robots, how you could just walk away and it would take care of it. That's just dangerous. So, you know, automation isn't necessarily what everybody thinks is being so great. Okay, so steps to automate. Got to make sure your broker and your platform support automation. You'd think, oh, yeah, of course, but there are some backtesting platforms that do not hook into any brokers and do not support automation. All they do is backtest. So that isn't what you want to do. You got to find somebody else to do it. Some of them require some good computer knowledge, which is API, which is a programming interface to get programs to talk to each other. A lot of them require programming ability. You know, some are simple, some are complicated. So you got to got to look and see what's out there relative to what you want, because what you want to do might not fit with all platforms out there. So just an example of Tradestation. I have a chart with the strategy running. So I've already created my strategy. I feel confident in it, and I just want to automate it. It's basically a 6-step process in one window. I turn the status on for the strategy to run it. I say generate orders, automate execution. I put my account number in for block number 4. I turn confirmation on or off in number 5. I hit close number 6. I'm automated. I'm running. So once you have it set up, that's pretty simple, right? Now, let's say I panic and want to turn automation off. I just go back and I can turn the strategy off. I can uncheck the automation box. You know, there's ways to turn it off. So it's pretty easy to turn off, which, unless there's something disastrous going on, probably is something you don't want to do. You know, if you have a strategy you believe in, you automate it, you want to let it run and just let it go. Once you do that, test it out in sim mode. You're not looking for profit and loss, but you're looking for, hey, does this send 50 orders an hour? You know, or is it acting normally? And you might laugh at that, but I was talking once to a guy at one of the major Chicago brokerages, and he was saying how he was automating with some software, and luckily he did it in sim mode, because whatever he did just kept placing order after order after order, and it was he said all of a sudden he was like long 1,000 contracts of soybeans. Now, of course, this is in the sim mode, so it wasn't actually real, but he said if he had been trading real, you know, he wouldn't have gotten to 1,000 because he would have run out of purchasing power. But the point is, he had a bug in his automation that was just firing off orders. So you want to test it out and just make sure it behaves. And then once you do, and it's kind of working all right, you know, not that it's making profit or loss, you know, you're not going to be able to tell really in sim mode. But then, you know, if it's doing what you think, you want to run it live. And, you know, maybe you want to be sitting there watching it all the time. Eventually, you won't have to be staring at that screen all the time. You can be doing other stuff and maybe have some alerts in the background to notify you, hey, something's going on. I need to check my position. So that's all part of the running live. Okay, so that's automation. Last thing I just want to touch on is then putting it all together into a business. So you have your strategies, you've automated a bunch of strategies. Now you just put it all together and create a trading business. You know, oh, that sounds simple. Yeah, the reality is it's really hard because there's a lot of people doing it, a lot of people who want to do it, and they're all trying to take money from you. You're trying to take money from them, basically. And so you have to constantly build new systems and research new techniques. You know, don't start, even if you had $1 million, don't start with $1 million trading, because pretty soon you'll probably only have $500,000. You know, that's the old joke. How do you get to $500,000 in your trading account? And the joke is, oh, you start with $1 million, you know, and then you lose. Don't do that. You got to treat it as a business. You know, they say 90% of small businesses fail. Trading's the same way. Probably 90% of traders fail. It takes a lot to be good at what you're doing, regardless if it's trading, if it's running a Subway, a sandwich shop, or owning some McDonald's, or owning a construction company, whatever it is. It's usually pretty hard, and anyone who owns businesses out there know you've got to constantly improve and evolve, right? You can't do the same things you were doing 50 years ago. You know, look at Sears Roebuck, for example. Yeah, they're still around, but they used to be the giant of the retail world. Now they're an afterthought. It just tells you they got to continuously improve and evolve. Okay, and there's obviously a lot to this that I just don't have time to talk about, but I think you kind of get the point. Okay, so just to sum up, gave you 3 nice entries. You can do a lot with these entries. You know, you could pretty much make a trading career out of just variations of all 3 of these and never go beyond them. And you know, depending on the strategies you came up with, you might do very well with it. Then we kind of took those entries and you saw how I created strategies out of them. And again, you can go to that link and you can actually get them. But the key, like I said, is really to test and evaluate those correctly. I just gave you a little snippets of tests. Be careful with that because there's a ton of different ways to test that are bad. So you got to watch out. And then with most software that's out there nowadays, testing and evaluating strategies is one thing, automating is something else. It's usually pretty simple compared to evaluating strategies. Where you're going to spend most of your time on all these steps at first is testing and evaluating your strategies. And then the bottom step, putting everything together and making a kind of go of it as some kind of part-time or full-time business. So that's kind of it. We'll do the book giveaway after we do questions, but right now I think Terry has some of the questions we can turn over. He can ask me some questions. If I don't answer it correctly or completely, I guess, I'll try to answer them all correctly. Or if we miss yours, feel free to email me. If you think of a question afterwards, email me at that address and I'll be glad to answer. But Terry, if you want to jump in with some questions and we can spend 15, 20 minutes, whatever it takes to get people some answers.
Okay. How short a time frame can one use with the 50/100 bar? Only day bars or shorter?
Well, the example I showed was actually, I think, a 60-minute bar. Now, I think in that book, Following the Trend, he was using daily bars. But that doesn't mean you can't use something shorter. What you'd be doing there is grabbing shorter trends, probably obviously less lucrative because, it's not going to be a big daily trend. It's going to be maybe a trend on a 30-minute chart, but you might be able to play around with that and get something that is good at that level. I don't know. You have to really try and see. But the example I gave, and that was the reason I gave that example, is it was a 60-minute because I wanted to show something besides daily bars would actually work with that.
Okay. I thought breakouts could be dangerous and it would be safer to wait for retracement. Any thoughts?
Yeah. They say 70 to 80% of breakouts fail. Okay. Well, you got to define failure. Failure implies it comes back, but then does the market take off after that? That would be your retracement question. So there you go. You take that base system and now you just put a little retracement component on there. You say, instead of saying if it hits a 50-bar high, you buy, the 50-bar high now is another condition that's met. Now you put it in a mode where you wait for the price to fall a little bit and then you're going to buy a retracement. Maybe when it falls and starts to come up a little bit, you do that. So that's something you could certainly add to it. It's a good idea. A lot of people like doing that, like buying those retracements. The problem is a lot of times if you look at some of the biggest trends in a lot of the markets, a lot of times they don't necessarily give you those opportunities to get on. They will just keep going and then you're you're sitting on the sidelines waiting for a retracement. It never happens. But the point is, if you have that idea, go and test it. And, the data is going to tell you if it's a good idea or not. I do that sometimes as far as I use breakouts, just go with them. I've also used some systems that use retracements, so I do both. But the best thing is to test it and see what works best for you.
Okay. Can you show the profit factor of the systems you've shown? I found that it's hard to find any system with a profit factor greater than 3.0, and anything better I would do better just by holding an ETF.
I don't have, you'd have to go and look. I only ran just a 2-year example, so I don't think it's appropriate to do a profit factor to show whatever that number is. I'm sure it's probably not 3.0. And I'd be surprised if there's an ETF, it depends how you're trading it, I suppose, that has a profit factor over 3.0. Most active trading is going to be somewhat less. I think you could create a back test that showed a great profit factor, but again, you got to be really careful with those back tests because they will tell you what you want to see and not necessarily what the future is going to hold. So be careful about that. But if you download the little package I put together, you can fire it up and run it over a number of years and see what you get. That's what I'd recommend.
Okay. The entry number 3 doesn't have or as many variables optimized. So is it a higher risk of overfitting?
It depends. It depends how you do it, because if you, let's say you instead of, I showed 5 or 6 biases that add up. Let's say you decide to come up with 50 of them, and each one you carefully constructed. Well, even though you're not necessarily optimizing those, you've kind of overfit because you've said, okay, if the close is greater than a certain close, if the RSI is a certain amount, if the stochastics are doing something, if there's this price pattern, hopefully you get my point that you can actually, without quote unquote optimizing a parameter, you can definitely overfit with that bias model. So you got to be careful with that. I think if you have too many biases that you have to all add up, you run the risk of it just being overfit. So yeah, the fear is still there. The way I look at it, the fear of curve fitting is pretty much with every system you create. You got to be careful.
Okay. What do you mean by burning historical data?
Think of it this way. So you have an idea and you test it on all the data you have, right? And you get a certain result. Say it makes $15,000, just for the sake of discussion. Then you go back and you tweak some rules and you run it again over all that data. And now it comes out to be 20,000. So you say, oh, well, I'm going to stick with that one. And then you add some more rules and filters, and now it's 25,000. And then you keep going back and forth, and you're using all your data all the time to do it. Eventually, you're going to come up with something really good. But what you've done is you've just optimized on that data, and now you have no other data to validate your model, right? You've basically burned your data. You've used it all up. And that's what most people do. I use walk forward testing, which is a form of out of sample testing, but even that, if you do it incorrectly, you can quote unquote burn all your data and render everything you do useless. And that's the ultimate thing, is when you do this, overuse the data, you run the risk of really overfitting your models, and that's kind of what I mean by it. You want to avoid that at all costs. Now, some of it's unavoidable. because you're trying different ideas, but there's a way to do it right, and there's a way to really overdo it, and you got to be careful, and you got to know the difference.
Okay. How does the nature of equities versus futures impact automation, or what seems to make futures work for you compared to equities?
Good question. I don't actually trade equities actively, so I can't really say, because I've never automated any kind of equity trading, so I'm not a good person to answer it. And so where I trade equities is kind of like in retirement accounts and that kind of thing. I do more long-term stuff, but I mean the concept's generally the same. I think you have to watch out for, with equities, some of the the sub-penny pricing where somebody's getting in front of your order and you're not getting as good of fills. But you could argue the same sort of thing is probably happening a little bit differently with futures. I just like futures trading for a couple reasons. One, the leverage, and two, the tax treatment's a little bit easier. I know people who trade in the U.S. trade stocks and have come up with a 50-page document of all their stock trades, where with futures, I literally get one number from the brokerage and put that on my one tax form. So it's a whole lot easier as far as record keeping, and capital gains is all different. And I could hold a trade for a minute in futures and it would still be considered in part a long-term capital gain. It's crazy, but those are the laws. So, but yeah, sorry, I don't want to talk too much about stock automation because I don't do it.
Okay. I'm trying to figure out how to say. Okay, you said one needs to keep on evolving. Normally, how long does a single strategy last?
Good question. It varies. I have some strategies that have lasted, last months maybe. I have some strategies that last years. I'll show you one. Let's see if I can pull it up here. It's a crude oil strategy I have. And you can see there's a back test from 2007 to the current date, and it hit a new high back in November, and now it's kind of in a little drawdown. But I started trading this one, I want to say somewhere around here in 2012. So you can kind of see everything to the right of that vertical line is real-time performance. So you could argue that one's worked about 7 years and it's still working. That's probably a little bit of an extreme example. I do have some other strategies I've been trading that long, but a lot of them just tend to fall off. What you don't want is you don't want them to break. Now, if they just kind of level off, well, that's a lot easier to take. Here's a good example of one that kind of leveled off in 2016. So, it was doing pretty good, and now for a couple of years, it's just kind of meandered down a little bit, but nothing super bad. I wouldn't say, so this strategy, I wouldn't say, hey, it's broken, you got to throw it away. But at the same time, maybe I should be developing some better strategies that, don't have this kind of thing. This is probably more typical with a lot of the strategies I have. But don't get me wrong, this doesn't mean these are the worst strategies. I mean, I have some that maybe I started trading it here, it's been doing well, and then all of a sudden it just starts doing bad. The key is you got to have a point where you say, enough's enough, I'm going to turn this strategy off. And that's where most people never come up with that, and that's the tough part.
Okay. Have you ever purchased an indicator or trading system that you regret?
Indicators, no. Boy, trading systems, I haven't bought too many of them, but I have uh, done some different things. I tended to want to do a lot of it on my own because I don't really trust anybody selling anything out there, which sounds kind of weird because I know, hey, I sell this workshop and yet I'm completely skeptical of the whole industry. Um, I tend to be more of a do-it-yourself where I try stuff and see if it works for myself. A lot of stuff like in books, I'll see a system in books and I'll try to program it and it won't work. I'll be like, what? But uh, I would say there's nothing I regret where I'm, except probably the one book that I bought. It was called "You Can't Lose Trading Commodities," and it was about scale trading. That was probably my biggest losing time ever, uh, and that I probably regret. But at the same time, it's kind of a journey, right? With trading, and you're going to make a lot of missteps along the way until you find something that kind of works for you. So in that respect, maybe I wouldn't be where I am today if I hadn't had the troubles earlier on. So I try not to look at things as, oh man, this cost me money. I just try to look at where I'm going and hopefully end up in a better place.
Okay, we're getting a little long, so I'm going to make this the last question so we can get to the book giveaway.
Okay.
What are some key items you look for when evaluating performance?
Um, the main thing I look at is obviously you want a good net profit, but you also want it to be good relative to your drawdown. I have plenty of systems that have great net profit, but when you look at the drawdown you have to endure to get there, it's not worth it. So it's really a risk-adjusted return. Now, whether you call that return to drawdown, you could call it a Sortino ratio, Sharpe ratio, Kalmar ratio, a lot of different ways to show it, but basically just remember the best metrics I think are going to include reward and risk at the same time, because you can't have one without the other. A lot of people think, oh yeah, look at the profit this makes, and they don't worry about the risk. Well, the risk is what's going to kill you. Option selling, I always thought was a good example of that, where people will go for years making money and they'll show a great equity curve, but they have all this hidden risk, and eventually it comes back to bite you. So and if you didn't account for it in the beginning, you're going to get in trouble. So that's kind of what I would look for, is look for like good risk-adjusted returns. Okay, if that's the last question, if we didn't get to your question, I'm sure we didn't get to some of them, just send it to me. I will be glad to email you an answer. Usually on some of these where we go and there's a lot of extra questions, I spend a couple hours in the evening answering questions, but I've put it out there, so take advantage.
Absolutely, and there are a lot of good questions, and it's just too many to get to. Also, if you're watching this later on YouTube, please feel free to shoot Kevin an email as well. All right,
Yep.
let's do.
All right, so let's do the giveaway, and Terry, I'll need your help with this. So let me put up the first screen before I put up the question. So Terry, you'll have to tell me or you'll have to somehow identify the fourth person, and that person can either email Terry will pass it on to me, or he can email me, and I'll get you the book.
I'll grab their emails from GoToWebinar and send them to you.
There you go. That's perfect. Okay, so get ready. It's going to be the fourth person to answer this correctly. So don't be first, second, or third. But all right, here's the question. Briefly name or describe one of the entries that I gave today. And once you think you have 4 answers, Tara, you can just shout out and people will stop.
Okay. Actually, I gotta. Okay. Was it small bias or little bias? The name of it?
Same thing.
Okay, got it.
Yeah, we'll give it close enough.
Okay, I'm sending you the first one's email. It'll be in the chat.
Okay, perfect.
It's
All right.
I can't pronounce the first name, but it's Van Beek.
Okay. So the answers for that first one were big funds. You want to do what the big funds are doing, the pro trader, that pairs thing, and little bias, small bias. Okay. So I've got that email, and let me just copy it just to make sure I grab it. And I'll be in contact with this person. So congratulations. And now we got one more question. This time I'm going to do the 5th correct answer. And get ready, 3, 2, 1, here we go. Out of all those steps that I talked about today, what are the 2 toughest ones? 2 toughest steps I talked about today.
All right, what's the correct answer?
All right, the 2 steps are test and evaluating strategies. So any words like that, and then putting it all together and creating a trading business. Those are the tough things. As I mentioned, the easy things are entries. Easy things are building strategies once you can do it. But the 2 absolute toughest are those 2. Hopefully you have enough correct answers.
Okay, I think I got it right here.
All right, perfect.
There were some that answered one, they didn't do the other one, so I had to kind of work through, but I got it. Here we go.
All right. Well, perfect. All right, so that kind of wraps it up, and I just want to thank you. I'll turn it over to Terry, but that's it. That's all I needed to talk about. So again, thanks, and good luck with your trading.
Absolutely. Thank you for the webinar, the information, and for spending some time with us this evening.